Our guest says the stock market is recovering. Valuations, he argues, at current levels are attractive. And even though tariffs are front and center, the next week of big tech earnings will be key to the direction of the market. Let's get more from Glen Smith, Chief Investment Officer at GDS Wealth Management. Glen, thanks very much for joining us.
My pleasure.
We touched on the rally in stocks over the past week, and you think that this is here to stay? We could be on an upward path here?
Absolutely. I mean, recessions, we don't think are in a forecast quite yet for 2025. We think this is just a little bit of a bear market. People often forget that corrections happen about every year and a half. Bear markets happen every 4 or 5 years, and they recover. The difference for them is always different. And in the case of this one, the reason is the tariff war, which the talk has been toned down significantly, which is why the market now is going up. We think this is an opportunity. There's a lot of stocks that have gone down, and we don't think it's justified. We think it's the tariff talk, which at some point is going to go away, either completely in cases of some countries or dramatically reduced.
That's interesting. You think that a lot of this trade war will cool down?
Absolutely. President Trump likes to negotiate. This isn't the way I would approach it, but I'm not president. I think he's trying to look at the long play, and he thinks this is the best way to accomplish it. My job as a financial advisor, try to take advantage of that. Where are some stocks that are getting hammered because of this? And once this irons out, how do we take advantage of it? Because there will be an end game to this. And at that point, you got to be positioned. You don't want to look back and wish you would have taken advantage of it.
You have some stock ideas for us, and we're looking forward to that. But are you being too cheery here, though? Because we know that supply chains are going to be changed here, and that's going to lead to higher costs, and it could take years of reduction, of adjustment. And also, our international investors, there are signs that they're more wary of the United States here because of the unpredictability of Trump.
If they've already announced over the last few weeks that they're carving out exceptions, whether it's car manufacturing, certain parts to it. So there are going to be unintended consequences that are not going to be desirable for the economy, but we think we'll still get through this. I don't think 10 years from now, the U.S. will be any weaker because of the decisions made today. But you want to look at what stocks might be hurt harder. China specifically, yes, they may have a tariff. Their tariff may look way different than other countries, even in Asia, whether it's Vietnam, Cambodia, Indonesia. The market's always resilient. There's been 5 times in history where you've had a 15% drop in the first quarter. In the first half of the year. There's been 5 times where the market's dropped 15% or greater. Every single time, the second half, the market's rallied big time, on average 23% on the upside. So I'm very bullish on equities over a long haul, regardless of the little blimps in it. And yeah, to your point, there's going to be some stocks that are going to hurt harder than others, and that's where you got to do a deep dive and know what you're buying in.
That's interesting as well. We began the year with the U.S. 10-year bond yield of almost 4.6%. And sure, we have seen yields move up a bit, but they're less than 4.3% now. Let's get into some of your stock ideas. Deckers Outdoor, remind us what they do and tell us why you like this name.
So this is a contrarian play. This would be an example of a stock that's been doing very well. Deckers, if you're not familiar with them, they're manufacturing many things, mainly shoes. The primary companies are going to be UGG and Hoka, among others. And this is a stock that's been doing amazing over the last 4 or 5 years. It's been taking market share from a lot of shoe manufacturers, Nike and others. This year, it's down about 45%. So it's had a rough year. And I don't know if they knew tariffs were going to come down the pike because of years ago, but Deckers has done a great job of moving manufacturing out of China. China still represents 40% of the shoe manufacturing, which is a large percentage, but the rest is primarily in Cambodia, Indonesia, and Vietnam. Now, what the administration did is they did tariff those other countries as well, but we don't think that's going to be long lasting. So at some point, when those are reduced, this is a stock that 6 months ago people would have loved to have, or especially 5 years ago, you would be up 4 to 5 times your money. So we think this is strictly about the tariffs. They have a ton of cash reserves, very little debt. I think this is going to be a huge opportunity over the next couple of years.
We're tight for time. Monolithic Power, I love that name. They're a player in the semiconductor industry. You see upside here.
Yep, Monolithic Power is a different semiconductor than NVIDIA's. NVIDIA's mainly do GPUs. Monolithic Power is very unique in that what it does is it does energy efficiency. So when you buy that car, when you buy that refrigerator, phone, its semiconductors are in there. That's why it's had a good year, even with the market pullback. It's holding up its own. It's because it's a little bit more diversified than just the rage of the AI semiconductors.
And then finally, JP Morgan would be one of your favorites in financial services.
Yeah, it's been one of our favorite for many years now, led by one of the best CEOs ever in banking. It's a little bit unique because we think even if rates stay where they're at, net interest margins are going to continue to be amazing and have record earnings for foreseeable future. If things do slow down a bit, rates come down a bit, we think lending will pick up, whether it's residential, commercial, and of course, mergers and acquisitions typically pick up with lower interest rates. So we think it's positioned in this environment, or whether rates come down and it's a slightly different environment, they're going to do very well.
Thanks very much indeed for joining us. Really appreciate it.